Karara Capital is a specialist Australian equities fund manager based here in Melbourne. The firm's 100% owned by the staff, which means there's no institutional imperative to grow fund levels to excessive levels, which can tend to crimp performance in the small cap space. Karara has a joint venture relationship with Ironbark. Each business is separately owned by different sets of shareholders. That joint venture arrangement essentially covers the marketing and distribution of our Australian equity funds, and from the investment management side, Karara is responsible for managing those funds. The small cap investment team is aligned on 3 levels. First is by co-investing in our funds that we manage. Secondly is via a bonus structure based on the performance of our small cap products. And thirdly is via our ownership of shares in Karara Capital, whereby all members of the team have equity in the business and are therefore incentivised and receive benefits based on the performance of Karara Capital. The investment objective of the Small Companies Fund is to outperform our benchmark index, which is the Small Ordinaries Accumulation Index, by 4% per annum over rolling 4-year periods. By style agnostic, we mean that our investment process isn't governed by any particular tilt towards value or growth elements. We see both value and growth being relevant in assessing a company's worth and then determining whether it represents attractive value at its prevailing trading price in the market. A key point of difference that our small cap team has versus a number of our peers is the level of experience that our team members have across all components of the small cap market, being both industrial stocks and resource stocks. A number of our peers tend to only focus on the industrials part of the market. A second key point of difference is that our team, our small cap team at Karara, is part of a broader team that focuses on the ASX 100 part of the market. This means that we have the ability to tap into their insights into the broader market, and we're not only getting insights on small caps. And finally, I think, versus our peers, we also have a very keen macro overlay, which comes out of our broader discussions within the firm and forms a key element of our investment process. In the small cap market, our investment universe effectively comprises over 2,000 stocks that are outside of the ASX 100 index. So it's a very large universe, and picking the best stocks in that is like picking or finding needles in a haystack. We start with 2 initial screens to exclude stocks with a market capitalisation of less than $70 million and stocks where it would take us more than 90 days to establish our initial targeted portfolio position weight in that stock. The next stage in our process involves applying a range of quality filters to that initially screened level of stocks. Those key quality filters include looking at a company's business model and the industry structure and how the business fits within the industry structure. We also focus heavily on management and whether we have any particular insights into management from previous experiences and so forth. We then apply a number of more financial type metrics, looking at return on equity levels, debt levels in terms of balance sheet gearing, and finally cash flow conversion in looking at how well companies convert their accounting profits into cash flow. From a stock selection perspective, our detailed due diligence process spends a lot of time focusing on the key drivers of each particular stock and the earnings and cash flows of those particular companies. When we then comprise a list of our preferred stocks, we make sure that there's not sufficient concentration in those underlying drivers. And then in our final portfolio construction process, we look at our exposures to particular sectors versus their sector weightings in the benchmark index. As mentioned earlier, a key element of our investment screening process is to exclude stocks where it would take us more than 90 days to achieve a target portfolio percentage weighting in that position. Then, once a stock is included in our portfolio, we monitor days to exit on an ongoing basis, and where a stock approaches our maximum number of days to exit, we put a cap on buying any more stock in that particular company. The recommended time horizon for investors in our fund is at least 5 years. This means there should be sufficient time to ride any periods of short-term market volatility and give the stocks that are in the portfolio sufficient time to realise their full value potential. I think investors should have exposure to small companies for a number of reasons. Firstly, there's greater diversity in the small cap opportunity set compared to the ASX 100, which tends to be biased towards the large banks and large resource companies. Secondly, investing in small caps provides investors with the opportunity to invest in higher growth, less mature businesses that often are disrupting an existing industry. I think thirdly, small caps provide investors with the opportunity to invest alongside highly entrepreneurial founders of businesses that tend to have large shareholdings in those businesses, and hence there tends to be a very high level of alignment between those external shareholders and the founders and the larger shareholders of those businesses. And then finally, I think from a valuation perspective, the small cap part of the market is a lot less researched from the sell side broking community, and hence there tends to be more information asymmetry and greater valuation upside.